Ladies and gentlemen, good day and welcome to the Q4 and FY26 earnings conference call of Flair Writing Industries Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Darshi Jain. Thank you, and over to you, ma'am.
Thank you. Good afternoon, everyone, and welcome to the Flair Writing Industries Limited Q4 and FY26 earnings conference call. Today on the call, we have Mr. Vimal Chand Rathod, the Managing Director, Mr. Mohit Rathod, the Whole-Time Director, Mr. Sumit Rathod, Whole-Time Director, and Mr. Alpesh Porwal, the Chief Financial Officer. A short disclaimer before we start this call. This call will contain some forward-looking statements which may be based upon our beliefs, opinions, and expectations of the company as of today. These statements are not a guarantee of future performance and will involve unforeseen risks and uncertainties. With that, I would now like to hand over the conference call to Mr. Vimal Chand Rathod, the Managing Director, for his opening remarks. Thank you, and over to you, sir.
Good afternoon and welcome to everyone. Thank you for joining Q4 and FY26 earnings call. I hope everyone had the opportunity to go through our investor presentation and press release that have been uploaded on the exchange. We are pleased to conclude the year on a strong note, delivering 15.8% top-line growth year-on-year, achieving our stated guidelines of 15% growth. Our new growth engine delivered outstanding results during the year, with creative rising 74% year-on-year and steel bottles and houseware recording an exceptional 94% growth for the year. FY26 has been a defining year in our transformation journey. We have evolved from being a largely pen-centric business into a more diversified enterprise, building strong momentum in high-growth categories and creatives and steel bottles and houseware. These two categories now contribute 31% of overall revenue. This marks a strategic shift towards a more scalable and future-ready and sustainable business model. At the same time, we have continued to strengthen our own brand sale, which contribute 91% of our business in FY26, a clear reflection of our growing strength and trust in our brand portfolio. We remain committed to deepening the mix further in the years ahead. Operations at our new Valsad facility are scheduled to commence from Q1 FY27, with capacity ramp-up expected by Q3 FY27. This expansion will significantly enhance our manufacturing capabilities across the pens and creative segment, supporting increased production volumes and enabling us to cater to growing demand across segments. In line with our strong performance and positive outlook, the Board of Directors have approved a final dividend of Indian rupees 50 paisa per share, representing 10% of face value of our equity share, aggregating 20% of FY year 26, similar to previous year. As we look ahead, we remain firmly focused on driving innovations and further deepening our brand leadership. This will position us to deliver enduring growth, creating long-term value and reinforce our leadership in the industry for years to come. I now hand over the calls to Mr. Alpesh Porwal, our CFO, to discuss in detail about our Q4 and FY26 financial performance. Thank you.
Thank you, MD sir. Let me begin with the financial performance for the fourth quarter of FY26. Revenue from operations for Q4 FY26 stood at INR 322.9 crores, an increase of 8.4% year-on-year. The gross profit for the quarter was at INR 165.3 crores, which increased by 14.1% over the corresponding quarter of the previous year. The gross profit margin improved by 258 bps year-on-year to 51.2%, driven by a favorable shift in the company's product mix. Also, the increasing contribution from the own brand sales has strengthened pricing power, resulting in an overall improvement in gross margins this quarter. EBITDA for the quarter was at INR 57.7 crores, registering a growth of 23.3% year-on-year. EBITDA margin stood at 17.9%, an increase of 217 bips year-on-year. As mentioned in our previous calls, that we are seeing operating leverage come through this year. This reinforces our confidence in the effectiveness of our ongoing business transformation initiatives, including increased automation, managing our human capital, and strengthening distribution relationships to support our expanding portfolio of innovative products. Profit after tax for the quarter was at INR 36.5 crores, increasing by 18.4% on a year-on-year basis. Profit after tax margin, that's PAT margin for the quarter, stood at 11.3%, expanding by 96 bips year-on-year, supported by disciplined finance cost. The stronger PAT growth was driven by a broad-based improvement in profitability, supported by expansion across gross margin, EBITDA margin, and overall PAT margin. Moving to our FY26 financial performance. Revenue from operations for FY26 was at rupees 1250, that's 1250.1 crores, an increase of 15.8% year-on-year. As mentioned by our MD sir, we achieved our revenue guidance of 15% this year. Gross profit for full year was rupees 637.8 crores, which increased by 16.4% on year-on-year basis. Gross profit margin came in at 51%. The gross profit margin grew marginally this year with 30 bips expansion. EBITDA for the full year was rupees 224.5 crores, increasing notably by 21.5% year-on-year. EBITDA margin also improved marginally by 85 bips to 18%. Profit after tax for the period was at rupees 141.3 crores, an increase of 18.7% year-on-year. Profit after tax margin for the year was at 11.3%, increasing by 28 bips. As reflected in the full year performance, margins across all levels expanded meaningfully. Talking about our working capital. Our inventory days stood at 97 days in Q4 FY26. It was similar compared to other quarters as we stocked up more inventory in advance during the quarter, anticipating further price in crude oil and its byproducts. On the other hand, our debtor days stood at 78 days. It reduced by 4 days quarter on quarter. And our creditor days stood at 37 days, a decrease of 3 days quarter on quarter. Hence, our working capital for Q4 FY26 stood at 139 days, which is also the same for full year. We regularly launch new products, maintaining higher inventory during the initial demand discovery and feedback phase. Based on market responses and sales forecasts, inventory levels are then adjusted to complete the product life cycle. Coming to our business segment results. Our own brand sales. Our own brand sales have continued their strong upward trajectory with consistent growth across the domestic market. Overall, domestic own brand sales grew by 17% year-on-year to rupees 264 crores. For full year, this number stands at 1017, that is 1017 crores, registering a 20% growth year-on-year. Domestic market has been a constant source of strength and underscores the favorable market positioning of all our products. Our own brand exports contributed rupees 34 crores to the total revenue in Q4 FY26, an increase of 31% year-on-year, while for the full year it was at rupees 122 crores, an increase of 29%. We have consistently focused on increasing our own brand sales and reducing reliance on OEMs, and we are steadily delivering on this objective. Our own brand sales now account for approximately 91% of the total revenue in FY26, marking a steady and consistent rise from 87% in FY25, 86% in FY24, and 80% in FY23. About our OEM sales. The domestic OEM declined from rupees 15 crores in Q4 FY25 to 9 crores in Q4 FY26. As highlighted earlier, our domestic OEM business has been fully phased out with legacy OEM relationships reduced to zero. Nonetheless, we are pleased to share that new customer engagements through our Flomex subsidiary have created an incremental revenue stream within the domestic OEM segment. Our export OEM business declined from rupees 32 crores in Q4 FY25 to 17 crores in Q4 FY26. It was mainly because of persistent inflation and subdued demand being experienced domestically by our clients, further aggravated by West Asia crisis. As the macro environment stabilizes, we expect export OEM to recover meaningfully, driven by normalization of supply chains, improved logistics, and a gradual revival in demand across key export markets, supported by enhanced customer engagement and execution capabilities. Our product segment results. First, our high growth segments of creative and steel bottles and houseware. The creative segment achieved impressive growth of 80% year-on-year growth for Q4 FY26 and 74% year-on-year for FY26, the whole year. The revenue contribution stood at rupees 86 crores for the quarter, that's Q4, and rupees 298 crores for the full financial year. We expanded our product portfolio by introducing 6 fresh offerings under the creative range during the quarter and overall 29 new products during the financial year. We recently incurred a capex of 20 crores FY26 for the Flomex facility in Surat, mainly invested in the new building and plant and machinery, and has already emerged as a revenue accretive driver for the creative segment. We recently operationalized wooden pencil manufacturing at this facility, a major category expansion in creative segment. We continue to scale the steel bottles and houseware segment as a revenue contribution for the quarter increased by a stellar 76% year-on-year in Q4 FY26 to rupees 22 crores as compared to rupees 12 crores in the corresponding quarter of the previous year. On full year, the segment generated sales worth rupees 85 crores in revenue, which is a substantial increase of 95% year-on-year in financial year 26. We sell 24 products in this segment with multiple SKUs. Our growth strategy in this segment is driven by 2 key levers: expanding the product portfolio and deepening distribution reach, particularly within general trade. Moving on to our pen segment. The total revenue for the quarter declined 4% year-on-year from 221.66 crores to 213.44 crores. The overall decline is entirely attributable to our pen OEM segment, which contracted 65%. Here, we also want to highlight that our own brand business in pen grew 9%, a high single-digit growth. This is a direct testament to the company's strategic focus on building and strengthening our own brand portfolio, which continues to deliver consistent growth. To summarize, while the pens business grew in FY26 with focus on quality and our revenue mix, showing a significant shift towards own brand sales, which now represents 95% of our pens revenue versus 80% a year ago. Coming to the geopolitical situation currently which we are facing. Despite the West Asian crisis and uncertainty looming over it, we would like to maintain the revenue guidance of 15% FY27. We remain confident about the upcoming year with a positive outlook driven by broad-based growth across all segments, supported by new product launches, enhanced manufacturing capabilities, and stronger distribution enabling deeper market reach. However, the ongoing West Asia crisis has inflated crude oil prices drastically, leading to a corresponding increase in crude-linked derivatives, which are one of the important components of raw materials. While Q4 margin remain insulated due to pre-stock inventories, which typically maintain inventory buffers over multiple months, we expect a margin impact in Q1 FY27 as higher cost inventory begins to flow through. Cost of such raw material have gone up from 10% to 50% on an average. So we are expecting an impact of about 13% increase in the consumption ratio. To mitigate this, we are strategizing a combination of rationalization of schemes and discounts. In household and steelware, we have also increased the selling price for all the products. With sustained focus on premiumization with a consistently rising share of mid-premium and premium products in new product launches, we expect to further offset the negative margin impact. Reflecting on the quarter, we take pride in delivering overall strong performance despite challenging macroeconomic conditions, and we extend our sincere appreciation to all our stakeholders for their continued support. Building on this momentum, we remain focused on sustaining our progress and driving the next phase of growth. Thank you. I would now like to hand over to the moderator to open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Aradhana Jain from 360 ONE Capital. Please go ahead.
Hi, thank you for the opportunity and congratulations on delivering a steady operating performance despite the volatile macro environment that we are in. My first question is how much is the salience of crude on our raw materials? And you mentioned that the prices have increased to around 10 to 15%. If you could throw some light of how much has the price hikes been taken during the quarter or even after that? And which SKUs would have seen the most price hikes? And did we witness any channel stocking ahead of the price increase that happened? That's my first question.
Hi, Aradhana. So when we say 13%, it's on an average for direct and indirect kind of materials which we use, the impact. Now, when I say I calculate it as 30%, it's on an average of raw materials, tips, ink, packaging and other decoration. Now, overall, this range is actually from, say, 0% in certain of these products from 5% to 50%. And the weighted average comes to 13% today. And that is why I said 13% is going to be the impact of the raw material price to crude. Q1. In Q1, yeah. And like I said, we also have these raw materials stocked up. So, which also kind of averages out the increase, the impact of increase in the raw material prices.
So how much is the salience of crude on our raw materials? Like, is it 30%, 40% of our raw materials is crude derivatives, or how is it, if you could?
35%.
35%. And did we witness any channel stocking ahead of the raw material increase that was happening?
Sorry, repeat your question.
Was there any channel stocking that happened ahead of the raw material price increase before basically the West?
So what happened, Aradhana, as the war started, as you know, the raw material prices started increasing. So there was something that we averaged out our purchase cost out here by buying in at the dips out there and also stocking in out there. Now what we see is that the pre-stock material, which is going to have my average cost not dipping down so much as it would be had I been purchasing the raw material at the current prices.
Understood. And you also highlighted that we might see some bit of dip in our margins because of the inflation in the prices. If you could throw some light on how much could the dip be there on our margins on account of the increase in the raw material prices?
So everything averages out, and the impact will be in Q4, a total of 13%, which would net up to something like a 4% or something in Q1.
Okay. Second, I wanted to understand. Sorry.
No, Aradhana, just to add, this 4% when I'm looking at which will eventually go down over the next 3 quarters. So as to end of FY27, probably we do a recalibration out here and we'll be kind of at the same levels of margin which we are today, maybe a percent of difference out here which we see.
Okay. The second question I wanted to understand is on the pen segment. If you could throw some light on how is the outlook going to be over the next 2 to 3 years. We were guiding for high single-digit kind of growth in the pen segment. We've closed the year at around 2%, while I understand that our own brand has grown at 9%. But going forward, how should one look at the mix between pens and steel bottles and creatives? Like, obviously, if we see last year, we were at around 77-78% of pens contribution, which has come down to around 68% this year. But going forward, what is the outlook on pens? And I understand the growth levers will be creatives and steel bottles. But if you could just help us understand what is the outlook going ahead.
Yeah. So, Aradhana, what we are targeting for the coming years is the writing instrument, which is pens, would be growing at a 5% on an annual basis. And also to add the high growth category, which is creative, we are targeting 50% growth this year as well. And for steel bottles, we continue to grow at 40%. So overall, if you look at the ratio, will come out to around 15%.
Understood. And during this quarter, our steel bottles revenue has moderated a bit if we compare that to, say, second quarter or third quarter. What is the reason for that, and how should one look at the growth in the steel bottles? That 23 odd crores of quarterly revenue. What is our outlook on that? How do we plan to increase that, and what are the steps that we are taking towards it?
Yeah. So if you look at the Q4, when we compare to Q3, of course, Q3 there was an impact of festivals. So obviously the sale was high at that time. And but going forward, we are strengthening all 3 fronts, which is to do with our GT, general trade, also the modern trade and e-com business, along with the quick com.
Understood. Thank you so much. I'll join back the queue for follow-ups.
Yeah. Thank you.
Thank you. The next question is from the line of Sneha from Nuvama. Please go ahead.
Hi, good afternoon, team, and congratulations on great numbers. Just a couple of questions from my end. What is the impact that you're now estimating in terms of margins going ahead, and for how long do you think that it will take to normalize? The reason I'm asking is you've already started taking actions in terms of reducing discounts and probably even increasing prices. But let's say if the situation continues with respect to polymer prices, if it continues to remain volatile, when do we see our margins normalizing?
Hi, Sneha. Sneha, like I said, when we look at a max of 4% in my Q1, this is the impact which I see. But if the war continues and the situation continues to linger, then what you were asking is how do we kind of manage it? Today we are not there in a lot of segments. We're not even touching the pricing, and the entire economics of the market would undergo change if this war continues. Because the rising prices, we obviously have to stabilize and we have to pull it for some. So in a nutshell, if I say, it will have an impact. The inflation will come in and it will have an impact on every product, including our products out here. So the ultimate thing is the rise in MRPs is what everybody will see. But today we don't envisage that this crisis would continue beyond next 2 or 3 months when it starts stabilizing by that time. So even if the war thing, the thing ends by say next week, what we are expecting or we read, the pricing, the stabilization will take some time.
Noted. And did I hear it correctly that for pens division now we are expecting around 5% sort of a growth and rest of the segments will lead to driving of overall 15% growth?
Yeah. Yes. Overall we look at 15%. When he said, what Mohit just said is 5% growth is what we are expecting in pens and 50 and 40% in creative and steel bottle which comes to 15%.
Got that. And lastly, I just wanted to, take your views on the inventory days reduction. Now, we've been targeting that for over a year or so. What is the progress that, we are making and what are the actions that we are taking? And FY27, what's the probable reduction that we'll be able to see in the working capital cycle?
So the entire working capital, if you see, our inventory days went up from 87 in the previous year to 94 in this year. And over the period, what we see is just a marginal improvement quarter on quarter also. Today we stand at 97 days. This is majorly because of the pre-stocking, as I said, which we anticipated, and just to safeguard our interest, we insulated with stocking a little extra. However, if you see my debtors and all, the numbers have started coming down in spite of these markets. It has come down by 2 days as I stand today. And so is my creditors, the number of days have reduced. That means I've started paying the creditors much faster. The cycle has become shorter. This entire impact would come to, this entire impact would work out to almost 9 days of increasing my working capital. Going forward, obviously, going forward we'll streamline the inventory. Now, the inventory pre-stocking was a one-time event, which we say. This is not what we are going to repeat. So, with the entire West Asia crisis moving in the direction, we see around 5 to 7 days of improvement in inventory in the coming 2 quarters.
Understood. Thanks a lot, team, and all the very best.
Thank you.
Thank you. The next question is from the line of Jinesh Joshi from PL Capital. Please go ahead.
Thanks for the opportunity. Sir, you mentioned that you have restocked certain inventory in anticipation of price rise. So can you just highlight how many months of cover do we have as far as 1Q is concerned?
So in my inventory, when we are say raw material and packing material, which makes up to around 40% of my inventory. And when I say stocking up of the inventory, it's around 4 to 5 weeks of inventory raw material which we stock up.
Understood. And sir, I just want to understand our export revenue growth trajectory a bit better, because if I look at our own brand sales, it has grown quite handsomely in 4Q, but our export OEM revenue is down, if I'm not mistaken. And given the fact that we are facing headwinds in export markets due to logistical challenges, ideally it should impact the OEM revenue on the export side as well as the own brand revenue. But there is some kind of divergence. One category is reporting a growth, whereas other is declining. So if you can just explain this bit.
Hi. If you see in the export market, the overall in the OEM segment, there are many factors, and recently due to the West Asian conflict that was going on, that impacted the overall route, even the freight cost and even the route towards the exporting market. But when I say the own brand growth, we had a significant, growth and even control on our brand and our strategies in those countries has helped us grow significantly in overall in the export market. And I think we in the going forward we continue to maintain that strategy. And now, as you know, we have also opened up 4 new countries, and overall we are 100 plus countries now in the overall export market.
Can you share out of the total export revenue, what is the share of these troubled countries at this point in time, and what has been the fall within that category as such?
So the overall export to the Middle Eastern countries is about 25%.
And the extent of fall that we have seen in this quarter, I mean, is it possible to kind of give some color on that?
So see, past few weeks or past couple of months, we have not been able to export there, mainly because of the the route is closed. But anyways, when we talk to our buyers and our distributors, they're very, very positive because the back to school season is coming there as well. So they are, very, very optimistic about the future business in this year.
Okay. And sir, just wanted to understand this growth guidance of steel bottles and creatives a bit better, wherein we are seeing a 50% growth for creatives and 40% for steel bottles. I think we launched about 59 new products in both these categories in FY26. So what is our plan for FY27 in terms of new launches and any touch point expansion that we are planning, especially on the steel bottle side? Because I believe on creatives we are at about 65 to 70,000 in terms of touch points. So what exactly is going to drive the growth in these two categories? And also within steel bottles, are we planning to add the 4th line anytime soon?
So when we talk about creative, as we have seen in last 6 to 7 quarters, the momentum, we have continued the growth momentum. And all the categories in the creative, we are getting a good traction. And we will continue to launch new products this year as well, because still we feel a lot of the categories we have to increase the depth of offerings of the products. And so the new launches will continue for this year as well. And when we talk about the overall coverage in creative, I would say we would maintain the same and reiterate that we would be increasing the depth of the and our throughput in each and every outlet rather than increasing the number of outlets. And to answer your other question in steel bottles, yes, we are launching a lot of new ranges in the coming year as well to increase the overall variety in the bottles. We would be since the base is small in all 3 categories, which would be general trade, modern trade, and e-com, the growth is going to be all across.
And 4th line, sir, I mean, any plans to add 4th line within the steel?
So we are planning. We are planning to expand our steel business by adding 1 more line.
Sure, sir. Thank you. Thank you so much, and all the best.
Thank you. The next question is from the line of Nitin Jain from Fair Value Equity Advisory. Please go ahead.
Yeah, thank you. My questions have been answered.
Thank you. The next question is from the line of Rahul Jain from Credence Wealth.
Yeah, thanks for the opportunity and congratulations on a good set of numbers. More specifically, we have been exceptionally well on the creative side and the bottom business. So the first question is, sir, with regards to the capex which we have done in last 3 years, our gross block has almost gone up from about 200 crores to 480 crores plus. The cash flow capex, which I can see from last 3 years cash flows, is roughly around 350 crores. So two questions related to the CapEx part. One is, see what further CapEx we plan to do in the current year, that is FY27. And based on the CapEx which we have done till now, and also the commercial start of operations at Valsad and Surat, the 20 crore CapEx. So typically with this kind of infrastructure, what kinds of peak revenues are achievable?
So just to add to this and give you a perspective, we capitalized, we had a capex spend of 104 crores in the previous financial year. And in Q4 itself, we had 40 crores. The major part of this capex is, like you, I think probably would try to say, is the plant and machinery and molds. That's a capex spend out here. What we see in the coming year, in this quarter, when we capitalize the new Valsad facility, so we have another outlay of probably 60 or 70 odd crores, and the total capex for the year would go to around 80-90 crores. Having said this, when we historically also, if you will see the number of times of revenue which we generate from our capital assets is around three times. When I say it's more than 3 times, so the similar revenue is what we expect from all the capital expenditure. Now, if I were to put the capital expenditure, give you a proper perspective, annually we have a replacement, etc., of around 40 crores. Now, with this another 72 crores of capex coming in, another 72 crores which we capitalize in Valsad over the period of 2 to 3 years, where we see we reach the optimum level of capacity levels, and it would give us a 3 times of this expenditure.
So just to understand this clearly, based on the current capex plans, which is one which is completed till 31st March, and one which you spoke about, the Valsad, we will have about further around 70 crores. So with this Valsad thing done completely, what kind of peak revenues are possible with this existing infrastructure? And do we...
facility, or are we talking about the total?
I'm talking about the peak revenue of the total. Because we have been doing capex for last 2-3 years now, continuously.
We have been doing capex, and we also building up manufacturing facility. What we see in the next the peak revenue from the assets which we would have would come to around 1750 crores of sales which we can do from these facilities which are building up over a period of time.
Okay. So including the Valsad new 70 crores addition, it will be 1750 crores.
Yes. That's the capacity which we will ultimately build and operate over a period of time.
Mm-hmm. Okay. And as we go forward, do we plan to reduce this intensity of capex? Reason being that somewhere due to the capex, or can we go to in terms of some kind of asset-light model so that our return ratios go beyond, say, 20-25%?
We're not thinking about an asset-light at this point of time. The way we are functioning out here by our capital outlays, and we're going to continue with that. So it's not that we are saying that we're going to have a lot of capital outlay, but as need basis and the opportunities at a given period of time, we plan the capex out there.
Okay. So within creatives, we have done exceptionally well last year, and again, we are expecting about 50% growth in the current year, FY27. So what top 2 or 3 product categories are driving this growth, and where do you feel still there is a maximum potential to grow at this speed of 40-50% for another 2 to 3 years to come?
So the maximum revenue growth, what we have seen in last couple of years, is in the pencil category, and also in the kids category. So pencil is going to grow further for next 2-3 years, and also we will be adding new categories in terms of the coloring range, the geo boxes. We would strengthen our position there as well. And when we talk about the pencil, it is all the pencils I'm talking about, which is the mechanical pencil, the wooden pencil facility which we just added in Surat, and as well as the 2mm mechanical pencil which we recently launched.
Sir, with regards to the rationalization of schemes which you have done and the price increases which you have taken across our product categories, as we speak today and we are entering the school season, school about to start, so how is the demand scenario as we speak today?
So the demand is extremely positive when we talk about the back to school season. So it's very, very positive.
So there is no dent on the demand post the price increases which we have taken.
Oh, no.
So, and last question, sir, just to clarify on the margin impact. So last year, our operating margins have been somewhere around 18% for the full year. And you did allude that, of course, due to the crude impact, there will be some dent. But for the overall year you said should be back to around 18% margins for the year as a whole. Is that understanding correct?
So last year the margins were at EBITDA, if I were to talk about, is 17.11%. And this year we are closing almost close to 18% EBITDA. Are you talking about these EBITDA margins or are you talking about the consumption ratio?
No, I'm talking about EBITDA margins, sir. Yes.
Exactly. So we said that we will be, last year also at the beginning of the year when we had the meet, we had said that we'll do anyways more than what we did the previous year, which was 17.1%. And throughout in the all the 4 quarters, we have kind of had a higher margin.
Very true. So I'm talking about the current year FY27. So you said there is some impact which margins will be there in quarter 1. But for the whole year, probably you feel that as we go forward, the overall margins for the full year can be around 18%.
So I think looking at the global scenario right now, I think the overall impact that we maximum see right now is a maximum of 1% up and down based on the targets that we have set.
Okay, so the range can be 17 to 19%.
Sorry to interrupt. Mr. Rahul.
Yeah, that's my last question. I'm just clarifying. That's my last question. So the margins will be around 17 to 19%. Is that understanding right?
Yeah. So like we said, that our target was towards 18, so we might see a impact of 1% looking at the global scenario.
Sure. Thank you so much, sir, and best wishes.
Thank you. The next question is from the line of Ananya Nichani from Thinkwise Wealth Managers LLP. Please go ahead.
Yeah, thank you for the opportunity. On the receivable stage improvement, I wanted to understand what exactly drove that and whether it's sustainable going forward. Yeah.
See, in terms of receivable, where we have shown an improvement, marginal improvement, is a simple thing. It's a process which we have started about the collection and addressing the needs.
See, also as you see, as the overall impact of the steel and the household and the creative category grows, this impact will further correct itself going forward. Because the strategies that we have put in place for these 2 particular segments are in a better manner as compared to the overall history of pens credit segments that we were maintaining. So I think going forward, as we have, like Alpesh said, that we have improved marginally, I think going forward with this ratio, we will further improve our numbers and number of days.
So the receivable stage will continue to improve, is what you're saying?
Yes, for sure.
Okay, got it. Thank you so much.
Thank you. The next question is from the line of Nilesh Doshi from Prospero Tree AMC. Please go ahead.
Thanks for the opportunity. Mohit sir, congratulations for the good set of numbers. Sir, the result could look much better if the standalone also has performed better and contributed, because since last 2 years, standalone profit is at the operating level, it is the standstill. Rather, it is reduced from the 2024. So what are the reason why the standalone profit is not encouraging, though the revenue is growing, but the operating profit is not growing? It is only the subsidiary which is generating the higher profit, and at the console level, the profit and revenue looks good. So what are the steps company is taking to improve the profitability of the standalone level?
So across all the companies, whether they are from the main company or the subsidiaries, the production of the writing instruments creatives are spread over. So it is not specifically to any particular company that the margins are improving. It is the overall turnover that happens, the way the expansion and the CapEx has happened in various categories in the new company, the subsidiary company, where, in 2017 when the tax regime had gone down, so major expansion is happening there. You understand? So the output of the subsidiaries will always be higher at overall level, while the holding company continues to maintain its growth.
Sir, our revenue is growing at the standalone level, and I think at the standalone level, we are operating the pen business, and that business is growing, the revenue is growing, but the operating profit is not growing. It was 176 crore in the FY24, now it is 155 crore, when we are reporting the 1,000 plus crore rupees of the revenue at the standalone level. So my question is why it is from 176 crore to 155 crore rupees, and the revenue from 900 to 1,000 crore rupees.
Firstly, let me just clarify over here that when we are looking at pens business, creative business, we use molding machines which are fungible between these things. And as legal entities where we are spread out over Daman, Valsad, Dehradun and Surat, what we do is a specific product is manufactured in a manufacturing facility. Now, this can be either of these companies, legal entities where we manufacture. Depending on the product mix again, and also on the market of that product, the sales is affected. However, if I were to look at it from the consolidated levels, you will see the improvement, or the best way to look at is consolidated levels. When you're talking of standalone legal entities, I would say that these are the byproducts of the product mix which we have manufactured and sold from those manufacturing units.
Okay, sir. So if we talk about the consolidated level, so there is a profit GP growth of 16%, from 547 crore to 637 crore rupees. The GP grew, in absolute term, it is 90 crore rupees. Our operating profit at the console level grew by 40 crore rupees. Why? Because the employee cost has grown by 43 crore rupees. If any year where we could not maintain the such GP, and because the employee cost is more of a fixed nature of cost, so we will take a hit at the operating level. So will it be a continued process of the employee cost is increasing, I think, the faster than our GP growth? So what is your thought on the employee cost, and particularly at the operating level? How it will look if there will be no GP maintenance or GP growth?
So I'll say employee cost, if you look at the absolute number, it might grow, but so does the sales grow. At our, if I do at the console level, my employee cost is percentage-wise same as 20 to 21%. It is consistent over there.
Because of job work.
Yeah. So the employee cost you see is a line item over there. That plus job work which is included in other expenses. If you were to total those numbers, then my employee cost remains between 20 and 21% throughout. So it won't, like your fear of it would have an impact on my profit. No, it's only the other expenses are decreasing if you see the numbers as a part of percentage.
Okay. Thank you, sir. Thank you. That's all from my side. Thank you, sir.
Thank you. The next question is from the line of Manpreet Arora from Arora Wealth. Please go ahead.
Yeah, thank you for the opportunity. Am I audible, sir?
Yeah.
Yeah. So, sir, first question is on the competitive landscape. Now, you mentioned that we can do north of, or we can do about 50% growth in our creative segment. And if you look at the creative segment, there are already players that are, where we have DOMS, we have Faber-Castell, we have Hello, we have, other Camlin, etc. Now, to achieve such a high rate of growth, will it be driven by a capture of market share, or do you think the market itself is growing at a very high speed? a high rate, and then, we can capture and grow at that rate. So if you can talk about the competitive landscape in general and how we are positioned to grow there.
Yeah. So what we expect from the growth is from we will grab the market share from the existing players in the category. And the main reason why we have been growing at such a high speed is the innovative products what we have launched in last 2 years, and the pipeline of the new products which we are planning to launch in the coming years is quite exciting. So based on that, we are super confident that we would be able to grab that market share from our existing competitors.
Okay. So primarily driven by capturing market shares.
Yeah.
Yeah. Okay. And of course, new innovative products. Sir, second question is on the Valsad facility. Now, previous quarter presentation said that it will be partially commissioned in the quarter 4. Now we are saying it will be commissioned or it will start in Q1 FY27. So has there been a delay in commencing the facility?
So I think, looking at the Q4 overall global scenario, I mean, there's a slight delay, but I think in Q1 it has already started functioning. So already the machinery, the raw material, that was partly delayed, but I think Q1, like mentioned, it has already started.
Yeah. So sir, our understanding was that once Valsad starts, a lot of the work that we outsource today on the creative side will come in-house, and that should also help us in improving our margins. Is that understanding still correct? And have you taken that into account when you're guiding for, because we are saying that we'll lose a certain margin because of the volatility, but still guiding for 17-18% end of the year. So that reduction in margin or that improvement in margin that we'll get from Valsad is accounted, I'm assuming, in the whole calculation.
See, as you see, as the overall impact is much higher, but considering that also, like what you just mentioned, the Valsad facility and bringing a lot of these, outside products in-house, that will help us maintain, and that's why we are restricting ourselves to that percentage. And we're still continuing with the guidance that we are putting in place despite the global scenario. So yes, definitely it will help us in sustaining and maintaining the numbers that we are targeted despite the global scenario.
Okay, great. So one last one on the marketing spend. Now, a large part of our customer base is students or, schools and college-going students. Now, given that, what is our marketing strategy? Is it, so we have a brand ambassador and then I think we do school reach outs where we try to increase visibility of a product and promote. But given that, the buyer is, young and school going, what are the other things? I mean, are we active on social media? And going forward, what will be our incremental marketing spend towards which channel? If I can talk about the strategy a bit.
So the strategy would remain the same. We would be actively promoting our products on social media, and as well as schools promotion will be actively on, and a lot of BTL activities in terms of using a good POP display stands and acquiring a big shelf space in each outlet.
All right. Yeah. So, and this has been a strategy in the last few years as well. What I'm trying to understand is has there been a change in the strategy or?
No, it's the same. It's the same.
Okay. All right. Thank you very much.
Thank you. Ladies and gentlemen, that was the last question for the day, and I now hand the conference over to the management for closing comments.
Thank you all for taking out time for this call. For any further queries and questions, you can reach out to our MUFG in time, our IR advisors. Thank you.
Thank you. On behalf of Flair Writing Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.